Well, hello, it's Chris here from Capital Counts, and welcome to another Meet the Fund Manager investment series. Today I'm kindly hosted by BetaShares. They manage in excess of $20 billion in exchange traded funds, commonly referred to as ETFs. Also today I'm kindly hosting David Bassanese,
Yes.
Chief Economist from BetaShares, who's got a strong history in economics, well over a decade with the Fin Review, and Senior Economist with BT and Macquarie Bank. So David is very well placed to talk to us about all things economic and markets today. Markets were really stellar from the March 2020 lows
Mm.
all the way through to 31st of December.
Yep.
And then we had what was probably called the perfect storm,
hmm
Russia, Ukraine,
Yep.
high interest rates, high inflation, and that really resulted in very, very poor returns for the first half of this year. So
Yeah.
we had the S&P 500 down about 23%. We had
Mm.
the Nasdaq down 33%,
Mm.
and then the Aussie ASX 200 was down about 15%. But
Mm.
then they've rebounded strongly. So
Mm.
I guess my first question to you is, and for our
Yeah.
audience, is it a dead cat bounce? Is it
Mm.
a false dawn, or is there some optimism on the horizon?
Look, I'm probably more cautious on that. I mean, I fear it may be a bit of a dead cat bounce. It really comes down to the good news is that oil prices have come off in the past couple of months. Bond yields have come off on the back of that. Inflation in the US seems to be peaking. So the whole reason for the sell-off was the surge in inflation, the very aggressive interest rate increases by central banks, which has led to, a valuation impact initially on the market. So higher interest rates have pushed down valuations. But the challenge now will be to get inflation sustainably down, you need to have a slower US economy. It's just too strong. And the markets at the moment are sort of hoping inflation can go down without having a material slowdown in the economy. And I think that's unlikely. So either the economy doesn't slow, inflation stays high, and the Fed has to do more raising interest rates, which is going to hurt the markets, or the economy will slow and get interest rates down, and which is going to hurt the market either way because of the impact on earnings. So I think there's still a lot of challenges out there despite the rebound that we've seen at the moment. But there is an upside risk, and it really comes down to US inflation. How quickly can inflation in the US fall over the next few months? The last reading was a bit lower than expected, very welcomed by the market. So if it turns out inflation does fall quickly, then the Fed can avoid raising rates and sending the economy into recession. But I think that's going to be the challenge.
And what about just defensive assets in general?
Mm.
We're seeing the capital values of bonds
Mm.
fall as interest rates rise.
Yeah.
Is it a good time to come back into that sort of bond market?
Yeah, look, I think so. I mean, the bond market, I mean, the markets have priced in aggressive central bank tightening now. And in fact, in the last month or so, again, one of the reasons for the equity market rally is they've priced out some of that aggressive tightening. I mean, they were expecting, case of Australia, the RBA cash rate to go up above 4% at one point, and the Federal Reserve rate to get up around that level as well. They've pulled that back down to around 3.5%. Which I still think is probably the worst case in terms of how far they do go with rates. And so in that sense, it is priced into the bond market. And if I'm right and the US economy does slow and potentially go into recession over the next 6 months or so, then bond yields will go lower because they'll start to price in rate cuts. So I actually think, you know, now is a pretty good time to look at longer term bonds. The worst is priced in, and if we go into a downturn, you're going to get capital gains as the bond yields fall back again.
And are there
Mm.
particular asset classes that you look at now with a higher inflationary, higher interest rate environment?
Look, earlier in the year there was when inflation was, fears were very high, and Russia invaded Ukraine, as you mentioned, and oil prices, food prices went through the roof. I mean, a lot of inflation trades at the time, things like oil producers, energy producers, generally resources, they did well. But I actually think the inflation trade per se didn't last very long because central banks responded by aggressively raising rates, and inflation is now sort of peaking and coming down. So I think the trade going forward at the moment is more defensive, going into defensive areas, things like, in terms of sectors, consumer staples, utilities, things that will hold up relatively better if we do have another leg down in the market. Longer term, I think central banks will get inflation back down again. We will go to a sort of fairly low inflation outlook again, which is going to favour the growth stocks, which have done so well up until the last 6 months or so. The things like global technology stocks, I see them coming back to the fore when we get through this downturn and inflation comes back to more normal levels.
With our clients, we obviously drip feed new funds into the
Hmm.
market now, just as a way to mitigate a bit of risk.
Yeah.
And sort of we are telling the clients that maybe some sort of normalisation into next year as we go through the cycle.
Hmm.
Would that be fair commentary to say, in your opinion? I mean,
Yeah.
albeit it's very challenging.
Yeah, look, I mean, timing markets is very hard, as you well know, and drip feeding into the market over time, makes a lot of sense. You're sort of less sensitive to getting that entry point exactly correct, and in a way, if markets sell off and you're regularly contributing to the market, the sort of dollar cost averaging strategy, you're actually buying, you're buying it at the lows, effectively, and that sort of strategy, yeah, makes sense. But as I said, although timing is hard, I mean, we have had a very strong equity rebound from
Mm,
COVID. Inflation's picked up. Unemployment rates are very low around the world, and so I think there is a period of normalisation, let's say, where we're going to have not as fantastic an equity market return over the next year or so. And maybe that will come in the way things work. Maybe it all happens quickly. That markets bottom, and then you can get a rebound thereafter. But yeah, it's a challenging. I think it's still going to be a challenging period for the next 6 to 12 months.
okay. That's typically our sentiment as well. If you
Mm.
had $1 to invest today, where would you put it, Dave?
Look, I like bonds, as I said before. I'm sort of defensively have a defensive view on the markets at the moment. So my view is that the global growth is going to slow. The worst is priced in terms of what central banks are going to do with rates, and the next move may be they start to price in rate cuts. Yeah, so I think bonds are the place to be at the moment, from a purely from a tactical point of view.
Hmm. Okay, well, look, thank you to BetaShares. Thank you to you, David,
No
for
worries.
hosting us today. And again, from our perspective with you, our clients, if you have any concerns, issues at all, please give us a call. Otherwise, we'll see you next time, David.
No worries.
Thank
Great
you
to
very
be with
much.
you.
Good on you. Cheers.